my dear friends. I hope you are doing well. Welcome back to Raya's studio. I am Raya. In this episode, we will not be talking about crypto, but about the rate hikes, tapering, Treasury yields, and the state of the economy of US. In the episode where I spoke about whether the bear market has bottomed, I mentioned that the crypto market is connected to the US stock market. Similarly, the trend of US stocks is connected to the US economy, which in turn is connected to the interest rate hikes, tapering, and Treasury yields. Therefore, before we try to do anything in the crypto market, not only must we first have crypto-related knowledge, but we must also know about the economic fundamentals of the current global financial center, the United States, the superpower. So, what are interest rate hikes, tapering, and Treasury yields? I believe that most non-economics majors have only heard of these terms, but have yet to do extensive research on them. Today, we will talk about the relationship between them. First, let's talk about interest rate hikes. Since March this year, the words Federal Reserve interest rate hike have been frequently mentioned. So, what exactly is an interest rate hike? An interest rate hike is the act of a country or region's central bank raising their interest rates. Interest rate hikes lead to higher borrowing costs for commercial banks, vis-a-vis the central bank, which in turn forces interest rates in the market to increase as well. An interest rate hike is a purposeful increase in the prevailing interest rate or rates by the central bank, or by commercial banks in general, including non-bank financial institutions, usually in order to achieve a specific goal. But what does it really mean? Let's go back to the United States. The Federal Reserve, as we might know, is the equivalent of the US Central Bank. The biggest role of the Federal Reserve is to print money and then lend it to other commercial banks throughout the United States. The other commercial banks can borrow money from the Fed and then lend it to their respective customers, or they can deposit money with the Fed to earn interest. When the Fed raises interest rates, which means that it raises the borrowing rates and deposit rates of other commercial banks. That is to say, if other commercial banks have to borrow money from the Fed, the interest rate on borrowing money is increased. But in turn, if the other commercial banks have enough money, so much so that they are able to deposit money into the Fed, then the returns for depositing money is raised as well. Let's expand on that. Say, the interest rate for borrowing money from the Fed increased. Then inevitably, commercial banks will also raise lending rates for their customers. Since the beginning of the Russian-Ukrainian war in March this year, the Fed has so far raised interest rates by 25, 50, 75, 75, 75 points. A total of 300 points, or 3%. In particular, the 3 consecutive 75-point rate hikes were the largest rate hikes since 1981. If I'm right, November will likely be a 75 points rate hike as well. And as for December, if the US core inflation index improves by then, it may drop to 50. But if it doesn't, it will still be 75. So, what are the economic consequences of an interest rate hike? The cost of loaning money is high. Then it is natural to reduce the amount of money borrowed. The return on deposits is high, so naturally you will save more money. Of course, only if there is money to save. Eventually, it will lead to the money in society slowly flowing back to the Federal Reserve. The money flowing in society will lessen. Hence the money in the stock market also lessens. Since the flow of money have been reduced, the stock market, in the absence of a sustained injection of liquidity, will naturally go into a decline. A while back, and even now, there have been bloggers talking about the return of the bull market after seeing a little jump in the market. To that, I would like to express that they may not fully understand the basics of the start of a bull market. The start of the bull market must follow the increase in the market. The overall money in the market is gradually decreasing. How can the bull market be back? I hope everyone considers this point and form your own opinions. Now, what about the reverse? By cutting interest rates, It will cause money to slowly flow back into the market from the Fed, and when there will slowly be more money in the market, naturally allowing the return of the real bull market in the stock and currency markets. Let me elaborate a bit more. At present, the world is in inflationary mode. The price of everything has gone up. Many businesses see a rise in cost, followed by a rise in the cost of loans, and eventually, a rise in the cost of loans will lead to poor liquidity. Enterprises with higher profits may only need to cut back on expenses, but some small businesses may walk right into bankruptcy. Expanding that to a global view, there will naturally be fewer US dollars in circulation. This means that all the dollars that were overprinted during the pandemic will slowly flow back to the Federal Reserve, and fewer US dollar in circulation will naturally lead to a more valuable currency. The dollar is worth more, so it is cheaper to use it to buy goods from other countries. Recently, we have found that the currencies of many countries have fallen drastically compared to the US dollar, such as Japan, the United Kingdom, euros, and so on. When the US dollar appreciates, it is cheaper to plunder other countries' goods. Over time, the United States of America's own inflation problem will naturally be solved. As for the other plundered countries, they would have to brush it off as bad luck. The first to bear the brunt of this situation would likely be the US allies, namely the United Kingdom, the European Union, and Japan. Similarly, another move that can bring about the same effect would be tapering. The concept of tapering is relatively simple. It means to shrink the balance sheet. So, what is the Fed's balance sheet? The answer to this is actually quite simple. The Fed's total assets equals total liabilities. Shrinking the balance sheet means shrinking assets and liabilities together. So, what are the Fed's assets and liabilities? The Fed's assets consists mainly of two categories. One is the financing of other institutions, such as loans to other commercial banks, securities repurchase agreements, etc. The other is the holding of securities, such as Treasury bonds, asset-backed securities, and so on. And the Fed's liabilities, mainly deposits, Federal Reserve notes, reverse repurchase agreements, etc. To put it simply, the money placed by the Fed in other institutions is an asset, while when other institutions place a deposit with the Fed, it is considered a liability. It is worth noting that the USD is not seen in the Fed's balance sheet. Why? No matter how much money you print, as long as the Fed does not use the money, it is a pile of waste paper. So once the US dollar is printed out, it must be used immediately, such as lending to commercial banks, financing, buying securities, and so on. This helps to explain the utilization of tapering, which is to reduce the financing of other institutions, and to reduce the purchase of securities assets, which eventually leads to sale of previous assets in order to get the USD back. So, what happens after the reduction? The dollar goes back to the Federal Reserve and then becomes waste paper. This results in the reduction of the total amount of dollars in circulation in the market. The effect of tapering is more direct than raising interest rates. After all, raising interest rates is just a slow process of waiting for the overprinted dollars to decrease, while tapering is a direct reduction. Likewise, it will further lead to the appreciation of the US dollar. Whether it's a rate hike or a taper, the ultimate goal is actually the same, which is to recycle the overprinted dollars and bring inflation back to a normal state of development. In a nutshell, the rate hike and the tapering are: the rate hike is to increase the cost of using the dollar, while the tapering is to directly reduce the liquidity of the dollar. As we've discussed before, a large portion of the Fed's assets are Treasury bonds. So, what are the Treasury rates and Treasury yields? Why do we often say that higher Treasury yields means bad news for the stock market? First of all, Treasury rates and Treasury yields are actually two different concepts. The Treasury is a kind of bond issued by the state, based on the credit of the state, issued by the central government to investors. promising to pay interest and repay the principal at maturity in a certain period. Because Treasury bonds are guaranteed by the state, they are recognized as the safest investment asset. After World War II, U.S. Treasuries, as a global financial center, were also recognized as the safest asset in the world. It has also become one of the anchors for the assets of most countries around the world. Unless the United States goes bankrupt, this situation will not change for the time being. The interest rate on Treasury bonds is also known as the coupon rate on Treasury bonds, and this value is fixed. For example, let's say you buy a 10-year U.S. Treasury bond with a $100 coupon, and if the coupon rate is 5%, then at the end of the 10-year maturity, the actual value of each coupon is $105, and you would have earned $5. Treasury bond yields, on the other hand, are situational, and your yield is directly related to your cost of purchase. For example, if you buy a $100 10-year Treasury bond when someone else is selling it at a low price to cash out, and you only spend $90, then when the bond matures, the actual value of the bond will still be $105, and you will have earned the equivalent of $15. So, under what circumstances would that cause Treasury yields to rise? This brings back the topic of tapering. When the Fed sells a lot of U.S. bonds, the market then has more U.S. bonds in circulation. The price of said bonds would naturally become cheaper. This will also correspondingly increase the yield of U.S. bonds. So, the yield of U.S. bonds increased. What kind of consequences will it lead to? Some of you may have already thought of this. It will lead to many funds flowing out of the riskier stock market or crypto market and into Treasury bonds instead. The outflow of funds will naturally also lead to a further decline in the stock market. As a qualified trader, once it is determined that the market will continue to fall, the first reaction is definitely to withdraw risky funds and switch to investments that are more secure. If Treasury yields become higher, it is natural to invest in Treasuries. On the other hand, if the yield of Treasury bonds has fallen, it means that fewer people are buying Treasury bonds, and money will flow to the stock market or the crypto market. These are all interlocked relationships. After listening to this, you should understand the impact of interest rate hikes, tapering, and rising Treasury yields on the U.S. economy, the stock market, and the cryptocurrency market, right? To conclude, the real bull market in the cryptocurrency market will be preceded by interest rate cuts, a halt to tapering, and a drop in Treasury yields. If you haven't fully understood these basic concepts, then you might still need some help when trying to grasp the market and make investments. Well, that's it for today. Remember to like and subscribe if you enjoy my content and would like more reviews from me. Thank you for watching my show. This show only represents personal opinions and does not constitute any investment advice. We will see you next time.